What if I told you that a single mistake could cost you years of financial growth? A mistake so big that it could be the difference between retiring at 40 or working until you're 70? Unfortunately, most new investors fall into these traps without even realizing it. And the worst part? By the time they do, it's often too late, but you're not going to be one of them. Because today, I'm going to reveal the 5 biggest investing mistakes that can destroy your wealth, and how to avoid them. Make sure you stick around for the final mistake, because it's the one that even experienced investors still get wrong. And it could be costing you hundreds of thousands of dollars over your lifetime. Let's get into it. Mistake number 1. Trying to time the market. Yes, the classic game of buy low, sell high. Sounds simple, right? Except, it's almost impossible to time the market consistently. Let's put this into perspective. Imagine you're at a casino, and the dealer tells you to predict the exact second the roulette wheel will land on red. Sounds crazy? Well, that's essentially what people do when they try to time the stock market. Statistics show that missing just the 10 best days in the stock market can slash your returns by over 50% in the long run. The solution? Time in the market beats timing the market. Instead of waiting for the perfect moment, invest consistently, whether the market is up or down. Because the real winners aren't the ones making lucky trades, they're the ones who stay in the game the longest. Pattern interrupt, and if you're still thinking, but what if I just time it a little? Trust me, even the pros can't do it. Unless you have a time machine, just stick to the strategy. Mistake number 2, investing without a plan. Picture this, you get in your car, start driving, but have no idea where you're going. No GPS, no map. Just vibes. That's exactly what happens when you invest without a plan. You end up lost, frustrated, and making impulsive decisions that cost you money. Here's what you need to do instead. 1. Define your goal. Are you investing for retirement, a house, or financial freedom? 2. Choose your strategy. Index funds? Dividend stocks? Real estate? Pick a path and stick to it. 3. Set your risk tolerance. If you panic every time the market dips, you're probably taking on too much risk. And speaking of risk, that brings us to mistake number 3, which can literally make or break your investing journey. Mistake number 3, ignoring risk management. Imagine putting all your money into one stock, and then waking up to the news that the company just filed for bankruptcy. That's what happens when you don't manage risk. Too many new investors go all in on a single stock, a hyped-up crypto token, or even a friend's once-in-a-lifetime business idea, only to watch their money disappear overnight. Rule number 1 of investing: never bet the farm on a single investment. Instead, diversify. Spread your money across different asset classes, stocks, bonds, real estate, so that if one crashes, your portfolio doesn't go down with it. Pattern interrupt, because let's be real, no one wants to be the guy explaining to his family that he lost all their savings on Dogecoin. Mistake number 4, letting emotions control your decisions. Investing is 80% psychology and only 20% strategy. And yet, most people let fear and greed run the show. They see stocks dropping and panic sell. They see stocks soaring and FOMO buy. This emotional roller coaster is the fastest way to lose money. The best investors? They stay calm. They know that markets rise and fall, but over time, the trend is always up. Here's a trick. Next time the market crashes, ask yourself, will this matter in 10 years? If the answer is no, stay put. Let time do its magic. And speaking of magic, the final mistake on this list is the one thing that separates the wealthy from the broke. And most people don't even realize they're making it. Mistake number 5, ignoring the power of compounding. Albert Einstein once called compound interest the 8th wonder of the world. And for good reason, because the sooner you start investing, the more time your money has to grow exponentially. Let me break it down. If you invest $500 a month at an 8% return, in 10 years, you'll have about $91,000. 20 years? $296,000. 30 years? Over $745,000. And that's without adding a single extra dollar. Time is your biggest asset, use it wisely. Pattern interrupt, and if you're thinking, I'll just start later, trust me, that's the most expensive decision you'll ever make. So, let's recap. 1. Stop trying to time the market. 2. Have a solid plan. 3. Manage your risk. 4. Control your emotions. 5. And never underestimate compounding. If you avoid these 5 mistakes, you'll be ahead of 90% of investors. Now, if you want to dive deeper into the power of compounding and see exactly how it can turn small investments into millions, click the video on your screen right now. Don't wait, because time in the market is ticking. See you in the next one.